This is Bloomberg Intelligence.
We're really getting into now the streaming arms race.
This is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today,
we're going to take a look at regional banks as their regulatory burden rises.
Plus, will light trucks carry the load for Ford through 2025?
But first, let's talk about fertilizers
and
nitrogen producers. It's my jam. North American nitrogen producers. So I'm talking about things like Nutrien, CF Industries, and LSB. Those are some of the companies. They're looking for fourth quarter sale surge. Now, there are still input cost issues, though. So let's get down to it with Bloomberg Intelligence analyst Alexis Maxwell. Let's just break it down. What do these guys actually make, first of all, and what inputs are still hurting them?
So those guys that you mentioned, they are nitrogen fertilizer producers, and they make products that farmers use like ammonia and urea.
How do you make those things?
So those products are made from natural gas. They're consumed in a process that we call the Haber-Bosch process, where they take natural gas, they crack it, and turn it into ammonia or urea, and then farmers use those products to enhance their crop yields.
When you are looking at these companies and the companies that make these fertilizers, you're making a call on the U.S. farmer. Is that right? And how does that work?
Yeah, so we're looking at U.S. farmer behavior when they come to the market to step in for material to fertilize their crops. We're looking at the farmer balance sheet. How are they situated? Do they have the cash flow and space in their budget to add maybe a little bit of extra fertilizers to enhance their crop yields this coming year?
I thought the fertilizer prices were like bananas right now.
Alex, you're right. They were bananas. We hit a record in ammonia pricing in the second quarter of 2022. And that was related to a series of supply shocks that was amplified by Russia's invasion into Ukraine. But the market does what it does, and high prices fell. Fertilizer prices are down 53% in 2023 alone, and it's really giving farmers a break because crop prices haven't fallen at the same rate.
All right, so that brings me to the question of the day. What is fertilizer-to-crop price ratio? What is that, and what's it telling you?
You said it.
So the fertilizer-to-crop price ratio is a way for the farmer to assess how affordable is this nutrient. If I add a little extra sprinkle of nitrogen onto my crops, am I going to see an economic bump in the material and the material that comes to me at the harvest next year? So farmers, they'll look at the fertilizer price, they'll divide it by the crop price of whatever it is that they're growing, and they'll use that to decide if they should buy more or if they should buy less.
Where's China in this? I just got a sense, not knowing anything about this market, that they probably export a lot of this stuff.
Yeah, that's actually a really good country to talk about, Paul, and I'm glad you brought it up. China is very important to the fertilizer market. They are a large exporter, a large consumer of fertilizers, and in the fertilizer space, they are the marginal producer. So they are the guys that, if they're exporting, prices are typically falling. And we've seen political developments in China influence that country's ability to ship material out to the rest of the world. China put an export ban on their fertilizers in 2021, and China stepped back from the global market to keep their material for their farmers. China is very sensitive about food security and growing enough to feed their population.
Is there a world where we can make synthetic fertilizer, maybe that's an oxymoron, or do it more cleanly? Because from what I understand, when you make fertilizer, you make a lot of ash, right? And that's like not good for the environment.
Yeah, so the direction the market is heading now, Alex, in terms of sort of cleaning up its act, if you will, is by trying to decarbonize. And the center of financial activity and where capital is flowing in the fertilizer market right now is to the United States after we passed the Inflation Reduction Act. You've got tax breaks in there for fertilizer producers to decarbonize their ammonia production. if I go back to the beginning when I mentioned the Haber-Bosch process that we use to crack natural gas and turn it into ammonia, carbon is a byproduct of that. And so this new Inflation Reduction Act gives producers subsidies to capture that carbon. It's a process that we call making blue ammonia. So what we see now is companies like Nutrien and LSB entering into this new market for what we call blue ammonia or decarbonized ammonia by spending money and enhancing their facilities.
Right. That can, though, be a bit expensive.
Making fertilizers. Interesting. How about that for Alexis?
What?
That's a skill.
You just converted him. All right, Alexis, thanks a lot. Alexis Maxwell, Bloomberg Intelligence analyst.
All right, let's turn now to HSBC, whose capital return scope looks underappreciated by the market. The bank is likely to extend its 2023 share buyback to a total of $8 billion, twice the amount baked in by consensus. For more on this, we're joined by Bloomberg Intelligence Senior Emerging European Banks Analyst Tomasz Noetzel. All right, Tomasz, so talk to us about HSBC and their capital return strategy.
As you mentioned already, we are expecting that HSBC will be able to deliver more than 40 billion in total capital returns in the next 2 years, into 2023 and 2024, which is equivalent to around 25% of current market cap, so it's quite a significant number. And we believe that the share buyback program can be extended in the second half of the year on top of 4 billion already announced in the first half of the year, and 8 billion very much look feasible this year. Another 4 billion is as well baked in consensus for the next year, and we also believe the profitability outlook will be supporting next year as well, and China is one of the risks that we are considering as a low at the moment.
Okay, well, let's get to the China part for a second, because they have exposure to China property, right? And I'm just wondering sort of how that puts these numbers into question.
Yeah, so that's very, of course, this is one of the risk factors we have to consider and take into account. However, we must be aware that HSBC has been doing quite a lot in terms of de-risking their property portfolio in China. Only this year, the outstanding amount declined by around 15%. It's around 14 billion at the moment. So if you compare it to the whole book, it's really around 1% or so. It's a very, very low exposure. The bank has been as well aggressively or progressively increasing the coverage ratios for those loans. So it's more than 60% at the moment, and possibly they are capable of extending more provisions in the second half of the year by around $600-700 million, and it's not going to derail their cost of risk target and final targets for this year.
So, Tomasz, since when are banks allowed to return so much capital to shareholders? Give us a sense of the regulatory environment over there that HSBC is dealing with.
Yeah, so I think HSBC is a little interesting story because, it's a UK bank, so it has to comply with the local regulatory here. So there has been some dividend restrictions that a couple of years ago when we had COVID times, etc., and banks were supposed to build the capital. But then we also had the Ping An, which is one of the largest shareholders for HSBC, and they were pushing very much hard HSBC management to improve the profitability outlook and to reintroduce the same dividends that we have seen in previous years, so around 50% dividend payout ratio and some special dividends. So they were pushing very hard. They wanted HSBC to get restructured, but what did management do? They just worked very hard to improve profitability. They had very good cost control, revenue momentum is improving, so they have very good return on equity outlook of 15-16% this year, next year. They've got very solid capital ratio as well, more than 14%, more than 14.5%, so well above 14%. Targeted by management and well above regulatory requirements. So they have all the scope and the power, I would say, to deliver those returns. And also they want to, I think, some kind of satisfy Ping An as one of the biggest shareholders, maybe to put it not very nicely, that to keep them quiet for a little while.
No, I mean, that's fair. Here's my confusion with HSBC. When I look for analysts, they're usually London-based analysts because it's a London bank. But in reality, this is a China play. And I'm just wondering, who owns this stock? What's the ownership of it look like?
If you look at the ownership, so apart from, of course, Ping An, there's lots of local investors as well in China or in Hong Kong. And suddenly when you look at the price performance of HSBC, especially after second quarter results, were very good results. But despite that, I think we had at least minimum 10-12% share price drop within the month. So these are all those investors who are starting to worry about Asia, so local investors as well who are then just selling off Chinese stocks or China exposed stocks, and HSBC is kind of the benchmark, I would say, for China exposure. Mm-hmm. But if you look at China, right, in the perspective of European banks and other banks and export to China, I think it's not only China, it's Asia slowdown per se, because I think that's what we should be talking about. Yes, China is one risk, but the contagion risk of China is the worry for the whole Asia region. Mm-hmm. But when you look at this, we have seen this for the couple of quarters already. We've seen the Asia slowdown. They've been very sanguine that they expected almost no growth in the next year or two. So this has, I think, already been discounted in the price and valuation of HSBC, but also Standard Chartered, who is another exposed lender to Asia.
All right, Tomasz, thanks a lot. We really appreciate it, Tomasz Noetzel. He is Bloomberg Intelligence Senior Emerging European Banks Analyst.
Coming up on the program, regional banks' regulatory burden may be more speed bump than roadblock.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
Regional banks face tougher regulations, but proposed rules on capital and long-term debt look manageable. For more, we're joined by Bloomberg Intelligence Senior Regional Banks Analyst Herman Chan. Herman, it's been a while since we've chatted with you, which means that we haven't had any more bank
No
failures.
Herman is good news.
No,
as sad as that is, right?
No one is good news to talk to Herman. So, Herman, we knew that when we had earlier in the year some of those bank failures, that these banks would face incremental regulations. What do we know now?
Right. So the regulators from the FDIC, from the Federal Reserve, they've all unveiled some parts of the changing regulation that will hit the regional banks and also the largest banks. What we know is that the capital ratio changes and the long-term debt requirements are a bit more manageable than prognosticators were thinking about during maybe 3 months ago. What's really been driving some of the consternation from the largest banks is higher risk-weighting assets, which lowers your capital ratios. And banks like JP Morgan have said they could get a 30% hit, whereas the regional banks that I focus on, we're talking about low to high single digits. So big delta there versus the largest banks. So that's why you're hearing some of the big bank CEOs complain a bit more forcefully than the regional banks that are just a bit more quiet.
That's part of the gig, right? I guess you talk your book on that end. Okay, the long-term debt issuance that they have to, or long-term debt that they have to hold, and then also the rules on capital they have to hold. Are they different or are they the same?
They are much different. So it's still a bit tiered, whereas I mentioned the capital issue, the largest banks require more capital. And this is the same thing with the long-term debt, where really the shortfall going forward for some of these banks is only a couple $1 billion, which is not that big of a deal for the likes of PNC and U.S. banks. So it's much more palatable, whereas prior to the unveiling, we were thinking about something in the 10 billion plus range. So definitely something that is more palatable across the board for the regionals.
So now that we have a little bit more clarity on the regulations, could that be a catalyst for some M&A, some consolidation in this space?
Yeah, so a couple of banks have talked about that recently, and they were asked about it at an investor conference. If you're close to that $100 billion mark, that means that you need to prepare for higher regulations from the things that we're talking about. Does that mean that it makes more sense to climb over that threshold at a much higher asset level so you can absorb some of these fixed costs more easily? That's something that banks like Comerica have talked about. Nothing's imminent, and Comerica is not going to pass over that $100 billion threshold anytime soon. But the banks that are at that level, like Comerica, Zions, East West, that should be something that's on their radar screen for the longer term to potentially conduct M&A when conditions are more open to sort of absorb these fixed costs.
So if they want to take on, they're like, you know what, M&A does make sense. It can help us with the burden, yada, yada.
Right.
Is the government going to bless it, or do they have to wait until one of them almost fails and Jamie Dimon buys it?
Right. So that's sort of the question.
It
There's
seems like at this point the government would be like, yeah, let's do it now before things get bad,
Right.
no?
You would think that would be the case where you do it now and then you don't take the hit for the FDIC insurance fund. You don't have some gyrating market conditions. Bigger is better, and we've seen that over the course of the past several months. And there are others in the Biden administration, like Janet Yellen and OCC Acting Commissioner Michael Hsu, have talked about being more open to M&A for the regional banks to compete better against the JP Morgans of the world. So that's something that the industry would love to continue to hear. That's one issue because the Biden administration has been a bit more reticent over the past several years. The second issue is that we're in this higher rate environment, and when you do conduct M&A, you have to mark to market the balance sheet of the buyer, and that merger math creates a tangible book value hit to the buying institution. So it doesn't make sense now, but once we get longer in terms of dealing with this rate environment, these interest rate issues could go away.
Where are we on the deposits here? There's definitely concern about deposit situation. How's it kind of played out here?
Yeah, so back during the turmoil in March and April, we saw a drop in deposits across the industry. Right now, that those deposits have stabilized. So you could think of it as the banks are paying up for deposits to create that stabilization. You see money market funds offering yields north of 5% now. So the banks have been forced to compete with that. And so they've raised their rates in kind to stabilize their deposit base. What that means is, well, that's great that deposits are stable. You're paying up, meaning your margins are getting squeezed. And that's the profitability issue that the industry is facing today. Weaker net interest margins, weaker lending, higher funding costs, not a lot of loan growth. So there's definitely an earnings issue going forward for the foreseeable future.
So typically I feel like when we see regulations come down and capital requirements come down, they're always solving the last thing.
Right.
Like they're solving the crisis that just happened. What is the harm? And we now see, say, for example, from the great financial crisis, the downside to those requirements for bigger banks in terms of their lending and their books, et cetera.
Right.
What do we think is going to be the problem that this creates?
Yeah, I think you're going to see very much a similar reaction where the great financial crisis, the banks don't hold residential mortgages on their balance sheet anymore, and they ceded that to some of the non-bank players, right? So you may see more of that going forward where these higher capital requirements, higher liquidity requirements that are still open for debates, it'll push some of the lending outside of the banking system, and you've seen the proliferation.
Which is already going.
Right.
Like, we're already seeing private credit's like the thing.
Exactly. And you're seeing more and more private credit coming into areas that they haven't touched before, like consumer auto lending and other areas like that. You could see private credit being a bigger player in areas like commercial real estate or small business lending. So these are areas that predominantly have been the arena for regional banks. And if regional banks are less open to lending, then other non-bank players will jump in.
So first of all, let's just look at the stocks here. I'm looking at the S&P Regional Bank Index. This thing hasn't bounced back. I mean, nobody's touching these things right now, right? So those headwinds you talked about, they're real, and investors are cautious, right?
Yeah, that's right. Around earnings season in the second quarter, there was a bit more optimism, but that's pulled back again. That's really driven by some of the headwinds that we talked about, the regulatory burden, higher interest rates, higher for longer, potential credit quality cracks going forward, less balance sheet growth, weaker earnings profile. It makes for tough sledding and hard given all of these negative headwinds affecting the regional banking space.
What company do you like the best right now?
Company I like the best. Yeah, there are banks like M&T and PNC that are a bit better positioned to deal with some of these burdens. M&T in particular won't need to have that big inflation in their risk-weighted assets, so their capital is a bit more stable. And M&T had some positive commentary at a recent investor conference saying that their top-line revenues should be a bit more stable. So those are some of the banks that I think can weather some of these negative headwinds.
All right, Herman, thanks so much. We appreciate that. As always, Bloomberg Intelligence Senior Regional Banks Analyst Herman Chan.
All right, coming up on the program, what's in the cards for the future of Ford? There are a lot of wild cards here.
Exactly. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
Well, Ford upended the auto industry more than a decade ago when it went all in on light trucks. But gains from that mix are now shifting, leaving the manufacturer in search of the next big thing. For more, we're joined by Bloomberg Intelligence Senior Automobiles Analyst Kevin Tynan. Wait, they're shifting? I thought everyone loved the Ford 150.
Yeah, not shifting away, but there needs to be the next step up, right? So Ford's revenue mix in the United States is 99% truck. So the idea is, how do we charge more? How do we expand margins on those products? And I think, the thought was, well, it's going to be the transition to electrification, right? There's more materials, higher costs. And it hasn't been as smooth as expected. So the problem is this transition has been very messy in terms of, okay, this is where we go to generate more revenue and profit. And I think that bridge is now going to be software and subscription services and things like this until the profit dynamics of electrified versions of trucks end up being profitable, or as profitable as the internal combustion technology is.
This is a big hole to fill here. Talk to us about what you think can be material. What can move the needle for Ford as they make this transition?
Yeah, so if you look, there's probably three areas that we would look at. One would be advanced driver assist systems, not saying full self-driving, autonomous, level 5, no steering wheel, no pedals. We're just talking about, that safety aspect that comes with level 2 or 2.5 or 3, that is lane keep, emergency braking, and things like that, that make driving safer. So safety is always a thing. The other one would be efficiency, fuel economy, engine management, things like that. And then the other one would be connectivity in the vehicle. So there's a lot of electronic and electric content that can come to vehicles in those areas. And I think that's going to be where the money is made, because ultimately when you think back, and Alex mentioned 10 years ago in 2013, when mix really started to shift from car to truck, that was profitable on day one, right? Now this transition to electrification, not profitable on day one, not profitable yet. But if you look at software, profitable on day one, right? And that's the kind of strategy. Those are the kind of initiatives that automakers want to be involved in. Is let's make money on day one now and go with that. So this is going to be the bridge. And look, it could be a lot more than a bridge. It could be, the way forward until maybe plug-in hybrids or some intermediate technology gets us to full electric, if ever.
Well, let me ask you this. So for so long, I feel like we talk about Tesla as being a software company or a car company, right? And we always thought the traditional guys like a Ford is just straight up car company. Can they compete with Tesla on like the software stuff?
Yeah, that's been the challenge, not just for Ford, obviously, for everyone.
For sure.
You see it in Europe. You see it in Asia-based manufacturers. That's the issue. The other thing, too, and people talk about the over-the-air updates and being able to do software without having to go to the dealership, and that's one of the advantages of a Tesla is that there are no dealerships, right? So a lot of those updates have to happen over the air, but Ford is also beholden to their dealerships in the sense that you're squeezing them out by sending updates over the air. And I think that's one of the areas that has to be figured out, is the local dealer getting a cut of those over-the-air updates? Because it just doesn't make sense to send people into the shop to do something that would happen over the air there. But that's really where the profitability is for the dealer base, and they need to be involved in that process because there's no money in selling new vehicles, maybe not even as much in used vehicles. It's all in the parts counters and the service bays.
Don't we know it? Let's talk about the Ford Bronco, Kevin. I see these things everywhere. How successful of a launch has that been for Ford?
Yeah, it's been incredible. By my calculation, it's still F Series is the big, that's almost half the revenue and probably a significantly higher percentage of the operating profit here in North America. But it's probably about 7% heading that way for Bronco in terms of revenue contribution. But all margin, it's just shared the space. I wouldn't even say it's taken market share from Jeep Wrangler, but very customizable accessories, and all that is just straight margin right to the bottom line. So, basic vehicle, add bigger wheels, tires, colors, graphics, push bars, lights, you name it, and it's profit for the manufacturer, and the dealership's been wildly successful. Anecdotally, I go to Detroit every year for the Woodward Avenue Dream Cruise, and Ford will have on 9 Mile Mustang Alley. Now there's an entire Bronco, half of Woodward, on down to 9 Mile is. It's probably a half a mile of Broncos, old and new, lining up now, and that's just in the last couple of years. So, huge success for them to take some space or to get into a space, and Jeep hasn't really lost a whole lot there either. It's just the whole segment has expanded.
You mentioned going to Detroit. At some point, if you go to a big auto show, do you think you're going to be going to a low tax, right to work state instead?
It's entirely possible, but I think it just needs to be worked out, right? There's certainly value. Those are knowledgeable workers, and this is the way the system is and the way it has to be. And I think it can work in states where it's non-union labor and where it is. The UEW is involved. It just has to be worked out. And I think when I look at what's going on, ideally, the automakers have been very profitable the past couple of years because of that mix shift, and the UAW has contributed to that profitability, and I think they want to get paid, right? And now the manufacturers are saying, yeah, but this is a smaller industry, right? We're doing more profit with fewer vehicles because they're more expensive. We've moved the whole market up, so I think the automakers want that flexibility to say, that old model or that old capacity footprint isn't going to work going forward, and we need the flexibility to adjust as we go.
So how do you think this, just real quickly, 30 seconds, how do you think this plays out, this labor issue?
I think the manufacturers get closer to the numbers that, and I mean the wage and bonus numbers that the union is putting out there, but retain the flexibility to adjust capacity and headcount going forward. And I think the old pension and healthcare for life kind of benefits are just a non-starter.
Yeah. All right, Kevin. Thanks a lot. We super appreciate it. Kevin Tynan, Bloomberg Intelligence Senior Automotives Analyst. Private credit. Those are the two buzzwords right now in finance. It's where all the money is going to. It's what everyone's talking about, and retail investors are trying to get into. Let's dig into it with Paul Gulberg. He's Bloomberg Intelligence Senior Banks Analyst. Private credit feels just like a huge bucket for just non-bank lending. Is that right?
I would say it is. And actually, the way we look at it, because the private credit managers now manage a ton of insurance money. We look at it in combination of where the private credit dry powder can go, and as well as the insurance assets from annuities can go as well, invested by those managers.
All right, so private credit, the issue that always gets me is this stuff regulated? And if it's not, is that a risk to the marketplace? Like the banks are regulated, like crazy. How about these guys?
In some areas it is. In some areas it's not. So if you take like a privately traded fund like BCRED, or you take a BDC company, there's a ton of disclosure. And this is investors' money, so it's not levered, or BDCs, for example, lever only 1 to 2, so very little leverage. So that kind of mitigates the credit. They're also able to extract better covenants for the loans, so that mitigates some of the credit too. The biggest risk for credit is not really regulation or lack of it. It's some of the pure private credit funds. They just don't have enough disclosure to the public markets that we used to.
So which funds have the most transparency? Which ones don't have that, et cetera?
So if you have a traditional private credit fund, it will have limited transparency. You'll have transparency to the LPs. The statements sometimes get audited, but the valuations sometimes raise questions and so on. If you have a fund that's going out to more retail investors, like a business development company that's publicly traded or a fund that's targeting the retail investors, those usually provide a ton of disclosure. So you can go on BCRED's website and see the portfolio of the companies in there.
So how big is the private credit business today, kind of in the world of fixed income?
So it's about $1.5 trillion. Just in the pure sense of private credit. And as I mentioned, there is also an insurance component, so that could be another number of hundreds of billions of dollars. There are some projections that it's going to grow to about 2.3 within 4 or 5 years, and it's very interesting. Mike Arrighetti, the Ares CEO, was quoted saying that he thinks it's going to hit $3 trillion.
Where is it all going?
Going in a sense
so it goes to all these like private credit managers like
Apollo,
Ares, yeah, sure, Apollo, Blackstone, KKR, Carl. Okay, so it goes to all those guys. Then what do they do with it?
They invested, so there is a lot of demand from investors.
But like, where in particular is like the hot place to invest all of that?
Middle market companies. So if we're talking about pure private credit, it's middle market companies. The guys typically under, let's say, $50 million or so, sometimes under $100 million of income, EBITDA. Though, that said, these guys gotten so big in terms of it being investors. So Blackstone and KKRs, they can actually write billion-dollar checks and take over very significant loans that banks used to do.
So are the banks just letting this business go? Because I started my career at the Chase Manhattan Banks, and we own the leveraged lending business then. What are the banks?
The government basically being like, you can't
exactly.
do that.
How are the banks responding?
Well, the banks are responding by giving up what they don't want or what they can't have, because the regulatory requirements are getting more complex, more stringent. Because of the capital requirements are getting more stringent, there's just a lot of stuff that they don't want to keep on their balance sheets. So they used to either syndicate it, or they're happy to just forgo it and let the private equity guys have it.
All right, that's kind of where I wanted to go. Like when we did a big loan at Chase, we syndicated out 90 or 95%. We took the fees up front, and then we got rid of the credit risk by syndicating it to other banks. Do the private credit guys, did they do the same thing, or are they holding a lot of this stuff?
They mostly hold it because it comes from their funds, although they do some of the big deals now that they actually syndicate it amongst each other upon underwriting. So they don't syndicate it in the sense of underwriting it and then spreading it with other managers. They kind of come together beforehand. But there's some of the big deals that they actually go and get together now.
But I guess in some ways it's different because if you're investing in a private credit fund, you know your money's going to be locked up for a good chunk of time, right? That's a little different than the bank sort of business model.
Yeah, absolutely. And this is how these guys
So that like
money.
mitigates a risk, right? Like if I'm going to give you $10 and you're going to go invest in private credit, but I'm not going to see that $10 for 10 years, that gives some flexibility.
A lot of flexibility, and this is where they make most of the money. They're not taking money. They're not making money on credit risk. They're mostly making money on illiquidity premium that they can hold those things forever and ever.
Yeah. So again, I'm going to come back to this regulatory issue here. I kind of feel like there's some risk here building in the credit markets, where a lot of capital is coming out of the regulated banks going into these light or less regulated private credits. Is anybody raising that as a concern for just the overall credit markets?
I would say not necessarily from a credit markets perspective, but you might have seen the SEC proposed and start requirements on the rules for more transparency. They're mostly not about the holdings that the private credit funds have, but they're fee disclosures and such things. So there is some effort in it. In turn, the private credit industry is suing them now.
So what? Yeah. Okay. Can we just game this out for a second? If there's like a big recession and there's a blow up somewhere and all of a sudden there are a ton of defaults, do we know what stress the system can take?
So if we're talking about $1.5 trillion in private credit globally, right, it still pales in comparison to $100 trillion market out there. There is probably about close to $40 trillion that can be within the realm of that private credit, in terms of the interest that they might have. So it's still a relatively small fraction. And one of the big things that the private credit does, they're very proactive. So the banks can restructure loans. Private credit managers typically even more proactive than there is. They also usually sit in the top, even higher in the capital structure, and they get better covenants than the banks can typically extract from the borrowers.
Oh, well, that's a good point. Okay, so there's a little more protection there.
If I were coming back as a young person onto Wall Street, private credit is a place I'd look.
You would?
I would.
I don't know if this is a good signal or it's a counter indicator. I don't know. I got to think about this one. All right. Thank you so much, Paul. Really appreciate it. Paul Gulberg, Bloomberg Intelligence Senior Banks Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.